What's up, everybody? Ryan Pulis here from the Pulis Group with today's real estate tax tips. We're a tax and accounting firm specializing in tax planning for real estate investors. Today we're going to discuss the 1031 exchange and the various rules required to successfully complete one. The Section 1031 exchange, also known as a Starker exchange, is one of the most powerful tools in a real estate investor's toolkit. This strategy defers capital gain and depreciation recapture on the exchange of real estate as long as certain conditions are met. If you complete a 1031 exchange, the transaction is reported on Form 8824 of your tax return. Internal Revenue Code Section 1031A1 says, "No gain or loss shall be recognized on the exchange of property held for productive use in a trade or business or for investment if such property is exchanged solely for property of like kind, which is to be held either for productive use in a trade or business or for investment." A little history about Section 1031. The concept of tax-deferred exchanges has been around since 1924. This area used to be governed under Section 112B1 of the Code, but in 1954, Congress replaced the old section with Section 1031. The Starker family case set precedent in this area of the tax law. The Starkers sold timberland to another party in exchange for a contractual promise to buy property that they identified within a 5-year time period. The IRS claimed that a delayed exchange did not qualify for tax-deferred treatment. Originally, the courts agreed with the IRS, but on appeal decided that the delayed treatment is acceptable, and this led to the development of the regulations we have today regarding 1031. As you'll see, you cannot delay for 5 years anymore. The Tax Cuts and Jobs Act changed the 1031 exchange rules in 2018 so that only real estate transactions qualify for this preferential treatment. Prior to 2018, a 1031 exchange could be used for a broad range of both real and tangible personal property. There are strict rules you must follow to complete a successful 1031 exchange. First, a qualified intermediary must be used to handle the paperwork and hold the sale proceeds during the exchange period. The investor cannot receive or take control of the sales proceeds from the relinquished property. The funds must go to and remain with the qualified intermediary until the transaction is complete. This rule is crucial and can ruin the entire deal if it's not properly followed. Second, the property must be held for productive use in a trade or business or for investment. This means items of inventory are not going to count. You run into this with fix and flip properties. Generally, in a fix and flip scenario, your properties are considered inventory and therefore they do not qualify for the Section 1031 treatment. Next, the replacement property must have a purchase price equal to or greater than the selling price of the relinquished property. The full selling proceeds must be invested into the new property. It's not just the gains. If there's a loan on the property, you'll have to use as much debt or more when financing the replacement property. In short, you can't take any cash out of the deal in order to keep it entirely tax-free or tax-deferred. Any cash taken out of the deal is going to be taxable. Next, we have the same taxpayer rule. The same person or same entity must be listed on both the relinquished property and the replacement property. If you hold the relinquished property in an LLC, the same LLC must buy the replacement property. There are exceptions when it's owned in a single member LLC and treated as a disregarded entity, but in general, it's got to remain the same. So the next two rules, the 45-day rule and the 180-day rule, run concurrently. They generally start with the same date you sell your property. So the 45-day rule says you have 45 calendar days to identify the replacement properties. The vast majority of 1031 exchanges, taxpayers will use the 3-property rule, which allows you to identify up to 3 replacement properties in the 45-day window. You are allowed to identify more than 3 properties, but then you run into additional restrictions and rules, and it's much less common, so we're not going to cover that today. You can always contact us to learn more if that's something you'd like to get a little more information on. The 180-day rule says the entire transaction must be completed by either 180 calendar days or the due date of your tax return, including extensions. So note that both timing rules are calendar days. So if day 45 or day 180 falls on a holiday, you want to make sure you can complete the deadline on the prior business day. So let's take a look at a few examples to demonstrate the concepts we just discussed. The first example shows us how the tax deferred treatment works. So Johnny owns property A that was purchased for $250,000. Over the years, Johnny took $73,000 in allowed depreciation, leaving a total basis of $177,000. In 2020, when property A had a fair market value of $350,000, Johnny successfully completed a 1031 exchange for property B valued at $400,000. He exchanged property A plus $50,000 cash to close the deal. His basis in the old property A rolls over and becomes the basis in this new property B, increased by the $50,000 cash he put into the deal. That gives him a total basis of $227,000. Had Johnny sold property A for $350,000 rather than doing the 1031 exchange, he would pay depreciation recapture tax on the prior depreciation taken of $73,000 and capital gains on the appreciation value of $100,000. With a recapture rate of 25% for real property and an assumed capital gains rate of 15% on the appreciation, his tax bill would have totaled over $33,000. He's able to defer the full tax liability of $33,000 by performing the 1031 exchange. That's pretty nice savings, and it's one of the reasons why the 1031 exchange is such a powerful tool. Now let's look at an example that shows how the timing rules work. So Johnny enters into a 1031 exchange on December 1st, 2021. He has until January 15th, 2022, 45 calendar days, to identify his eligible replacement properties. The exchange must be completed by April 15th, 2022, even though 180 days is not elapsed unless he files for an extension. If Johnny files for an extension of time to file his return, he has until May 30th, 2022 to complete the exchange. That's 180 days from December 1st, 2021, when the exchange began. One of the best strategies available for real estate investors that would like to leave something to their children or their heirs is the swap till you drop strategy. Section 1014 of the Internal Revenue Code allows property to pass to heirs with a stepped up basis. What this means is that when someone inherits a property, the IRS resets the basis of the property to its market value on the date of the original owner's death. You can use a 1031 exchange as many times as you like to trade up in tax-free during your life and then leave the property to your heirs with a new basis at the current fair market value on the date of death. To continue with the exchange example we just looked at, Johnny exchanged property A plus $50,000 for property B and now has a total of $300,000 invested in property B. Let's assume he holds on to this for many years and passes away when it has a market value of $1 million and has been fully depreciated. He leaves the property to his son Robbie. Robbie will receive a step up in basis to the current market value of $1 million and can now begin depreciating the property again at this higher market value. That's assuming he's using it as a rental. If he would decide to live in the property, there's no depreciation, but he still gets that full step up in basis. To recap, the 1031 exchange allows investors to defer capital gains and depreciation recapture on the exchange of real property, but there are strict rules involved in doing so. You must use a qualified intermediary. The purchase price of the new property must be equal to or greater than the selling price of the old property. You have 45 days to identify replacement properties, usually up to 3. You have until the earlier of 180 days or the due date of the return, including extensions, to complete the exchange. You can use a 1031 exchange as many times as you like and then leave the property to your heirs for a step up in basis. Performing a 1031 exchange is not something you want to try and do on your own, so be sure you're working with professionals to make sure the deal is successful. That about wraps up our discussion today on 1031 exchanges. I hope this video has been helpful. Feel free to comment below and hit the like and subscribe button. We are taking on new clients and will review your prior year tax returns for planning opportunities. Thank you and have a great day. If you'd like to work with us, then hit us up on our webpage at thepulisgroup.com/contact. That's ThePulicegroup.com/contact.